At Baillie Gifford, we're watching unfolding events with COVID-19 closely, and our thoughts are with those affected. Investors should be reassured that we continue to function successfully with all staff working from home, and the day-to-day management of the Monks Investment Trust remains unaffected. Our initial focus has been to review the financial strength and resilience of the portfolio. We believe that in aggregate, the portfolio is well positioned for what is likely to be a challenging demand environment for companies moving forward. There are three key points about Monks' current positioning. The first is that the portfolio is modestly exposed to cyclical or economically sensitive companies. As managers, we've been reducing this exposure in recent years. When the current Global Alpha team took over the trust in 2015, the portfolio had around 30% invested in cyclical growth companies. Today, that's significantly less, at around 20%. These moves have left us in good shape in light of recent market moves. The second point is that the portfolio has low levels of indebtedness. Its aggregate debt to equity ratio is less than half the benchmarks, which reflects our preference for quality growth businesses. In reducing the portfolio's cyclical exposure, we've been allocating this capital towards what we classify as rapid growth companies. Many of these businesses are asset light, are in good financial shape, many have net cash balances on the balance sheet, and are supported by growing structural trends which we believe should persist, if not accelerate, in the current environment. And I'll touch on that later. And finally, the portfolio is minimally exposed to the energy sector. As one of the hardest hit sectors, Monks has benefited from having little exposure to oil and gas businesses. Today, the portfolio exposure here is less than 2%. However, investors should be reassured that we're not resting on our laurels. We've continued to work hard to identify those holdings in the portfolio that we believe could be hardest hit by the likely demand shock to come, and are actively engaging with those businesses. Overall, we've been encouraged by our further findings and have acted quickly and decisively when required. For example, we've reduced some of our emerging market bank exposure, over which we had some concerns around growth prospects and asset quality in light of the pandemic. Reappraisal of the existing portfolio is an ongoing task, but we believe the picture is a reassuring one to date. An important part of our role as managers is to continue to seek growth opportunities. Our first port of call has been to consider whether the response to COVID-19 is likely to accelerate the adoption of products and services which underpin the growth prospects of many holdings in the portfolio. Indeed, companies like Netflix in entertainment streaming, Microsoft in productivity applications or cloud services, and Spotify in music streaming are all examples of companies which are held in the portfolio and are experiencing increased demand for their services. Therefore, the question we are asking is, may this increased demand actually be structural rather than just temporary? We remain open to the broadening growth opportunities for these companies. Beyond the existing portfolio, our experience of navigating periods of extreme stock market volatility have taught us that these conditions can be happy hunting ground for stock pickers. We've begun to consider where we see the greatest dislocations between share prices and fundamentals, and for example have been considering several enduring brands and franchises which we believe could be potentially unfairly discounted in share price terms. We believe now is the time to consider companies that we know well through our research, but do not yet hold. This is likely to yield better results in the long term for shareholders than to frantically begin looking and researching new ideas in light of share price falls. To summarise, the extreme market conditions that we've seen in recent weeks does not alter our fundamental approach. We continue to seek long-term growth opportunities. Monks' shareholders should be reassured that not only is the portfolio sensibly positioned with regards to debt and cash flow perspective, which is important in the near term, but that we believe the portfolio's growth prospects from here remain exciting on a long-term view. An economic crisis can often tilt the playing field in favour of innovation and the most adaptable companies, many of which we believe are held in the Monks portfolio.